All right, good evening. How are we doing? Again, not being able to record an actual video, so I'm going to do this live. And I want to basically just go through some of the things that we already kind of know, but give some helpful tips for a change. Because I'm quite aware that we've been covering a lot of the news, and it hasn't necessarily been positive. So hopefully, this will be something that will give you some actionable tips, steps that you can go and take. But first, let's start off by just kind of recapping where we are right now. The budget is coming along in about 3 and a bit weeks to the end of the month, effectively. We're going to find out what Labour are planning in terms of tax hikes. We have spoken about the fact that they've rumored that they will be looking to equalize capital gains tax with income tax rates. There's likely going to be something around pensions, likely going to be something around inheritance tax, possibly. And a whole host of other things. But what I want to do in this video right here this evening is talk about how you can kind of start to shield your money from those tax hikes specifically. And I'm talking about capital gains tax mainly, and also bringing into the equation here the personal savings allowance. So what I'm going to do is I'm going to scribe. I haven't done this for a very, very long time, so just bear with me whilst I get all of this together. It should all work. So let's just bring this on, and let's start off with personal savings allowance. If you're here with me live, would you mind putting a 1 in the chat if you can hear me and you can see the little screen that should be right here? Just give me a 1 in the chat. That would be amazing. So let's start off with personal savings allowance. I was going to say everybody gets this, but that's not true. So your personal savings allowance is something where if you have a savings account and you put money into it, you can earn a certain amount of money in interest before you start to pay tax. Now, for a person who's on a basic rate of tax, paying the basic rate of tax, the allowance is £1,000. If you're paying a higher rate tax, which is 40%, can't speak, you get £500. And if you are at the additional rate, you get 0. Okay. Now, these rates have been frozen since 2015 or so. And what we've seen recently is with the Bank of England base rate going up, savings rates also going up. And what that means is that effectively now, if you have £10,000 in an account getting a 5% return, you're effectively going to start paying taxes, because obviously that's going to give you a £500 return for the year. So you'll start paying taxes on the interest that you actually gain. And from looking at numbers and looking at some of the statistics out there, about 2.75 million people are being dragged into paying tax in 23, 24 because of all of this. So this is something that is to be mindful of. You still have the £1,000 allowance, but literally once you start crossing that £500 limit, if you're a higher rate taxpayer, you're going to start paying taxes. Some of the things that we're going to talk about here will likely be very, very helpful for you. Now, the next thing to think about is capital gains tax. Now, there's been a lot of talk about this. I think what they'll likely do, if they don't already choose to reduce the capital gains allowance, the capital gains allowance right now is £3,000. So put it up in the corner right there, £3,000. There may be a reduction to that. We don't know. It is more likely, though, that they're going to do what has been posted in the news, increasing the capital gains rates from where they are currently. So if you're a basic rate taxpayer, you're currently going to be paying 10% on any assets that you dispose of and 18% on a property sale. If you're a higher rate taxpayer, it's 20% on assets you dispose of and 24% for property that you sell. Now, the plan has been that if they do equalize income tax rates and capital gains tax rates, what will happen is if you're a basic rate taxpayer, you're basically paying 20% here. And if you're a higher rate, then you're paying 40% here. And if your additional rate will be 45%. So effectively more tax going into the coffers for the government, which is essentially the whole purpose of this whole thing, right? They want to be able to drag in more money into the coffers. So if this actually happens, what it basically means is that you're going to be paying more on anything that you have outside of your tax efficient wrappers. Now, for those of you who've been following me for a long time, and I have to say this, and I'm also going to say something else as well, is I am a qualified financial advisor. I don't practice anymore. I walked away from that to do what I do now, to try and talk about these things in a way that's easy to understand. We have a conversation about this on social media. That's really my passion right now. But I've not worked on, I haven't advised on any of this kind of stuff for a while. So please don't take it as financial advice. Now, what I'm going to talk about in terms of tax efficiency, the first rule of financial planning is tax efficiency. And what I'm going to talk about next may require you, if you're at that point where you have maybe a little bit of a complex financial situation, you may need to speak to an accountant to see how this actually bears out because of the nuances that are often involved with this. But what I am going to do is I'm going to keep it really, really high level, really, really simple. So let's talk about ISAs first, okay? There is an opportunity at the moment, and in financial planning land, as a financial advisor, when you start to get to this side of the year, heading into the new tax year, you start to really have these conversations with people around: are you utilizing your ISA allowance as much as you can? And yes, the ISA allowance, as you know, is £20,000. It's a lot of money. Not a lot of people actually get to use their full allowance during the course of a tax year. And what I typically say to people is, look, it doesn't matter whether you're using 5 grand of it, 10 grand of it, 3 grand, or even £500 of it. Use it, max it out, because once the tax years are gone, if you haven't contributed in that tax year, you can't roll it back like you can with, say, things like pensions, for example, go back and use unused allowances. So use your ISA allowance regardless of your situation, regardless of how much you might actually have. What I'm going to talk about here, though, is talk about the best case scenario. So you do have quite a lot of money lying around and you can use the full £20,000 allowance. And I'm going to do that because it paints the picture of the vast sums that you could potentially have in here. Now, as an adult, your allowance for 2024, so this current tax year. So if you don't know, the current tax year runs April the 6th to April the 5th every single year. And so what that means is between now and this date in 2025, for an adult, you've got £20,000 that you can put into your ISAs currently. So let's assume you're able to max that out. Now, if you did have money lying around in 2025, you could also put £20,000 into the new tax year's ISA on April the 6th, 2025. Now, that's £40,000 across these two tax years currently that you can effectively utilize. If you have kids, well, you have a £9,000 junior ISA allowance on either side of the tax years. That's £18,000 here, okay? Total here, 40K here. Now, if you're a married couple and you have the ability to use your top whack in terms of your ISA allowances, then what you would then do is you would times this number, well, times it by 2, because that then becomes £80,000. And by the way, this is per kid. So if you had 2 kids, then that's £36,000. If you had 3, then it's obviously more. It's £28,000. So what I'm trying to say here is that ISAs are going to be really, really important. Tax efficiency being the most important thing when you look at financial planning, right? So for those people who are lucky enough to have large capital around, and let's just say, you're a married couple and you have a kid, right? Between now and April the 6th, 2025, this will tell you that you've got what? £98,000 that you could put into ISA tax efficient wrappers right now, between now and the beginning of the new tax year. Okay, well, let's say the new tax year starting on April the 6th, 2025. Like I said, this is very much a utopic kind of like picture for those people who are lucky enough to have that kind of cash line around. But I think it makes the point of, please make sure that you utilize it. Utilize as much of it as you possibly can, because even if it is 5 grand or 3 grand or whatever it might be, you might be saving for a house deposit, you could be saving for whatever. Having it within this environment is really important. Now, they have spoken about the fact that there may, and I hope that they don't do this, I hope they leave this alone, that they may introduce a cap on how much your ISAs can grow by before you start to pay tax. That rumor has been £100,000. Now, that would be a pretty big departure from where we have been with ISAs over the past, what, since 1999, since ISAs were introduced in their current form, where it doesn't matter how much you have in there and it doesn't matter how much it grows to, it's completely tax free. Yes, it would allow the government to be able to access more cash for sure, but I sincerely hope that they don't bring this. Now, back to this conversation around capital gains. This is going to be a really important one. If you have money in a general investment account, a savings account, something like that, that is not tax efficient, isn't in an ISA wrapper where you have that tax efficiency, you're not using your allowances, potentially you're going to be in a taxable environment. So what you can do, again, using ISAs, is use something called bed and ISA. And this is how it essentially works. So let's just say you have 20K in a general investment account right now. That money is invested, right? Now let's just assume you get a 7% return over the course of 10 years, and you just left the money in your general investment account. You didn't put it in your ISAs. Over that 10-year period, your gain would be £19,343. Now, assuming that they kept the capital gains tax the same as it currently is right now, and they kept the capital gains allowance at £3,000, this is what your tax bill would be, about £3,269. Now, let me just work this out, and let's just say I'm going to keep the allowance there at £3,000. So we're going to take that off it. So your taxable gain would be 16,343. But let's just say that you are a high rate taxpayer. So this is 20% as a high rate taxpayer. Let's just say they equalized income tax with capital gains tax, and you had to pay 40% of tax on this. You would be paying £6,537 in tax if they were to introduce and do what we think they might do at the end of the month, which is equalizing capital gains tax and income rate taxes. For a high rate taxpayer, you're paying $6,500. So what you can do is you can consider something called bed and ISA. And that is basically, it's bed and breakfast. It's the general rule, but I'm using ISA as a substitution here. And the rule is, sorry, and the rule is that if you have an asset, so you have an investment that you sell down, but you repurchase that within 30 days, it isn't classed as a capital gains event, so you don't have to pay capital gains tax on it. Now, connecting the dots, it means that this money that you might have currently sat in a general investment account, and I'm not telling you to do this, but I'm asking you the question, would it be advisable to sell and move this money into an ISA to ensure that it gets into that tax advantaged environment? Again, you've got that 30-day rule, and I don't know your personal circumstances. You may have a really complex kind of like situation. This is where you're going to need a little bit of tax advice, but that right there is a little bit of an idea that is possibly worthwhile thinking about if you are looking at the back end of this month and you're a little bit worried about what Labour might do and what changes might actually come in. So look, that's what I wanted to share with you this evening. I hope you found this useful. If you did, please do me a favor. I am doing this live. Please ensure, and if you can, please smash the like button. It just means that other people who may find this beneficial will see it, because the YouTube algorithm will take it as though you enjoyed the video, and it will recommend and push the video out a little bit more. If you haven't already subscribed and you're finding me for the first time, please consider subscribing. But guys, I thank you so much for joining me this evening. Like I said, I didn't have time to do a recorded video, so I thought, in opposed to kind of like missing this, I'll just do this as a live kind of conversation. I'm just having a look at the chat right here. I did a workshop yesterday, and I had a question about gold, and Paul here is saying buy gold and silver, sovereigns and Britannia, capital gains exempt. You are absolutely spot on with that as well. And with everything that's going on in the world right now, I wouldn't be surprised if precious metals like gold and silver actually end up going in value as well. But thank you so much for watching me this evening. I hope you have a good evening, whatever it is that you decide to do. I'll catch you on the next one. Cheers.